In today's video, we're talking about the exciting growing market of telehealth care. And specifically, we're talking about Teladoc as a company that you can invest in to get some exposure to this growing market. It's supposed to grow at a compound annual growth rate of the upper 30s through 2025, which is an insane growth rate for a market in general. So we're going to talk about Teladoc specifically around some of the risks that I see with investing in the company, as well as obviously the pros to investing in the company, as well as kind of where I see the stock going in the short to long term. If I was going to sum up what Teladoc Health as a company is or what they do, it's essentially a platform to connect healthcare professionals across a variety of medical specialties with consumers. And they don't just have one brand. It's Teladoc, BetterHelp, HealthiestYou, Livongo. They've been on a buying spree when it comes to brands and expanding their services. So whether someone's looking for a therapist or maybe they have a cold and they just want to check in with a doctor, they can do it all through the different platforms that Teladoc Health has. But the real game changer for me was when they merged with Livongo, which is a company that focuses on chronic illnesses and managing those illnesses for people. So whether it's diabetes, high blood pressure, all this stuff that a ton of people deal with, using data and technology, they offer a way to manage those with real-time data to make sure that people are living a healthier lifestyle and at the same time can reduce their costs for their overall healthcare. And here's why all these acquisitions are really important to the company, because they realize if it's just a website that connects you with a healthcare professional and that's it, there's no competitive advantage, and that can just be copied, which we'll talk about, because there's other competitors that are doing something similar. Now, if they become a one-stop shop for everything telehealthcare, that's where they have the opportunity, because then someone can go to the website, get connected with a healthcare professional, and then if there's any illnesses discovered or issues, they can follow up over time to manage that, as well as now they have data analytics when it comes to healthcare, and all of a sudden they're this one-stop shop. It's seamless, everyone uses the service, and then they're basically the best in the industry when it comes to telehealthcare. Because like I said, they're not the only ones in this space. There's MD Live, which they're planning to go public in early 2021 because they realize if they don't go public, raise cash, and are able to expand their services, they're gonna fall behind Teladoc very quickly. There's Doctor on Demand, and then you have the ultimate company entering the space, which scares everyone. Amazon, which is Amazon Care, which was initially launched as just an internal project for Amazon employees, but they're slowly rolling it out to the entire country. I can't remember the exact day, but when Amazon did announce that they were going to roll out Amazon Care to all of the US and not just internal, the stock for Teladoc went down around 8%. But the same thing happened with CVS when Amazon announced they were going into pharmacy. And the same thing with grocery stores like Costco when Amazon said they were going into groceries. And all those stocks ended up recovering over the long term. So I think in the short term, the stock market tends to overreact when Amazon enters a market. But as we talked about at the beginning of the video, the telehealth market as a whole is growing pretty fast. So it makes sense to see a lot of competitors. And the thing is, with all these competitors, it doesn't mean that only one company will succeed. You could have multiple of these companies actually be good investments and all grow together. Back to Teladoc though, let's look at the financials when it comes to the fourth quarter results, as well as the full year 2020, as well as a little glimpse into 2021 as they provided guidance. If you look at the total visits from 2019 to 2020, there was a growth of 156% year over year. So with that huge increase in bookings, you can also see that total revenue year over year was increased by 98%. Now, part of that growth is due to the pandemic, and the question is, okay, well, if the pandemic goes away, will those visits actually retract? Will they reduce? The thing is though, this kind of opened Pandora's box. Once people realize that you can perform all of your healthcare needs virtually for cheaper costs, well actually, okay, now you have a new customer that actually may not go back to the old system. Looking forward, the growth may not be as explosive, but it doesn't mean that those visits that were started this year just instantly go away. And we'll see that when it comes to the revenue projections as well. So with all that revenue growth, you would hope that would translate into profit. Unfortunately, no. They had a larger net loss in 2020 versus 2019. But let's take a look at the details of why. As you can see here, the loss in 2019 was 98 million, but in 2020, it was actually 485 million. And it really comes down to this line item here, loss from operations. But a big part of this loss was due to the merger with Livongo. Because if you read through the 10K, you'll find a section for adjusted EBITDA. So if you take out the stock-based compensation of $475 million, the acquisition and integration related costs of $88 million, actually the adjusted EBITDA for the company grew from $31 million to $126 million. So this company is definitely more focused on growth, acquisitions, and continuing to invest back in the business over extracting profit and return it to shareholders. So this is definitely more a growth play versus a conservative, oh, this company is generating a ton of cash flow. This is more of a speculative growth play on a growing market within the telehealthcare market. So through 2020, they had a revenue of $1.1 billion. 2021, a year that maybe you would expect, okay, with the pandemic slowing down, maybe the revenue stops growing as fast. Well, they're expecting in 2021 to have a revenue of close to $2 billion for the full year. So they're essentially doubling the revenue again. If they can just keep on doubling the revenue, that would be huge for the company. So when it comes to valuing the company, it doesn't really make sense to assume doubling of revenue each year. I mean, that's insane. So using something more like 38% compounded annual growth rate for the next 5 years is a little better. Now, using the following assumptions for a discounted cash flow model for 5 years, I come up with around $172 as a fair value for the company. And looking at a stock chart for the company over the past year, you can see at the beginning of 2020, they exploded in terms of stock price, and then kind of over the past year, they've consolidated. Currently, they're trading around that 180 range, and they were close to 300 in February. Obviously, the stock has gotten slaughtered since then and has come down to 180. And what I believe around this range of 170 is a fair area to be buying into the stock. Now, if we look at something like the historical price to sales ratio for the stock, it trades in a range of 10 to 20 over the past couple of years. So using 2021 projected revenue of around $2 billion, you kind of get a range of 131 per share to 262. I did this whole Patreon post a couple weeks ago, and I was able to buy some around that 170 level, and I'm continuing to add a little bit more to the position around this 180 level, as I expect the stock to kind of get to the at least 200 range or mid 200s by the end of 2021. So for me, it's a stock that obviously there's not a huge bargain price. I mean, if this thing went to 130, I would be buying up way more. But at this price, you know, I'm kind of dollar cost averaging into the position, and for a market that's growing so fast, I think paying fair value or around that area makes sense to get exposure to this growing market. And if this thing comes down to the mid 100s, the low 100s, I mean, I'm way more comfortable in adding a higher percentage of my portfolio in this growth play. But for now, you know, going into about 1.5% of my portfolio. Not that I put too much weight into this, but Teladoc is around 6% of the ARK Invest ETF, which, you know, is always a little comforting. Knowing Kathy Woods is in my corner too. Well, there you have it. There's my opinion on Teladoc Health and kind of the pros and cons of investing in this company. Obviously, all just my opinion, but if you did enjoy this video, consider giving a thumbs up and subscribing to Main Street Wolf, where I'll do stock reviews, I talk about options, all that good stuff. Try to teach you kind of how I'm thinking as an investor, and maybe you can get some takeaways as well. Thanks guys for watching, and have a great day.